We're recording.
All right, welcome everyone. Good afternoon. This is Orkide Gargozli. I'm from the Department of Economics. Welcome to another presentation hosted by Economics Honor Society here at Montclair State University. So the title of our conversation is GameStop, Short Selling and the Madness of the Crowds. Our guest here today is Todd Federman. He's an instructional specialist in the economics department here at Montclair State University. Soon after he graduated from college, he began trading options for his personal account. After earning his MBA, Mr. Federman began a 25-year career as a trader. He started in bonds and then switched to stocks. He created a statistical trading model where short selling was almost 50% of his business. After 25 years, he retired, and for the last 12 years, he has been teaching at Montclair State University, beginning as a math adjunct and then moving over to teach economics full-time. Here with me are two of our excellent students and our graduate assistants, Venetia Patel and Morgan O'Neill. So you can introduce yourself, and then I'm going to turn it over to our guest here, Todd Federman.
Hello, everyone. This is Venetia Patel. I'm an MBA student and a graduate assistant at Economics Department. To all the students out there, in case if you need help with microeconomics, please reach out to me and we'll be happy to assist you. Have a nice presentation, guys. Over to you, Morgan.
Hello, everyone. My name is Morgan. I am the graduate assistant for the macro side of things. So if you need help with macro, please feel free to book me. Thank you.
Thank you so much. So now I turn it over to you, Todd, and I look forward to the presentation.
Thank you very much, Orkide. All righty, I'm going to start sharing my screen.
I'm so sorry to interrupt. I just wanted to remind everyone, if you have a question, I would appreciate it if you direct it to me in the chat room, and we can answer Mr. Federman at the end of his presentation. And while he's speaking, maybe you can click on the speaker view to have a better, vision of the presentation. Thank you.
Right. Okay. Thank you very much. Yes, everybody, please direct your questions in the chat room to Orkide, and we'll have time at the end. The presentation is going to run approximately 40 minutes. There's a lot here to unpack in terms of what happened in GameStop stock. My name is Todd Federman. I teach economics at Montclair State University at the Feliciano School of Business. For those of you who are not familiar, the Feliciano School of Business has 6 departments. We have over 25 undergraduate and graduate programs, more than 2,700 BA and BS students, over 775 in our MBA program, both in person and online, and that's been growing very dramatically. We have over 100 full-time faculty. Before I came to Montclair State, I worked on Wall Street for 25 years. This photograph was taken approximately 1982. First, I was in bonds, and then for the last 18 years, I traded stock. Approximately 50% of my trading was long, which means 50% of my trading was short. So when I saw this happen in January, I said to myself, let me see what's going on here. Maybe I can shed a little light with my perspective of 18 years of trading, a lot of it being short. So my goal here today is to go over the following items. First, I'm going to explain a short sale, how it works, and why you would short. Then take a look at financial manias. Are there any things that have happened in the past that look like what happened at GameStop? We're going to examine what happened to tulip bulbs, not tulips, tulip bulbs, back in 1635. And then we're going to look at the trading in in Northern Pacific Railroad back in 1901. And it's going to turn out they both look somewhat similar to what happened in GameStop. Then we'll look at GameStop. We'll take a brief look at what they do and some financial statistics. We'll look at the trading, stock symbol is GME. We'll look what hedge funds did. Then we'll examine what is Reddit and Wall Street Bets. It's an internet message board, and we'll see what impact that had on the markets. And then finally, we're going to look at Robinhood Financial or Robinhood Securities, the securities firm that help facilitate a lot of trading in GameStop. Anytime that guy shows up, that's me. So what exactly is a short stock sale? It's a sale of stock that you do not own. How, you might want to know, is that possible? Well, there are 3 steps. Number 1, you have to borrow the shares. Then you have to sell the shares. And then eventually you have to buy the shares back and return them to the lender. Why would you want to short a stock in the first place? Well, there are technical reasons and there are fundamental reasons. Let's take a look at technicals. You might think the price is temporarily too high. Perhaps it recently outperformed peers. Let me show you a sample of the kind of trading that I used to do. Here you see a graph of MasterCard stock from April 1st to sometime last week. The scale on the left from 220 to 400, that's the price of MasterCard. You also see a graph for Visa, but it's 1.6 times the price of Visa. What's the first thing you note? They're almost identical in their trading pattern because they're very similar companies. But sometimes they trade apart. In the area that I'm pointing to here, MasterCard has, in a recent time period, outperformed Visa. So it might be the case you want to sell short MasterCard and buy Visa as a hedge. 3 weeks later, they came back in line. If you sold short MasterCard at that high point and covered it when they came back together, you made 49 points because it went down 49, but you were shorted. If you bought Visa and then sold it down at the bottom, you would have lost 29 points. Altogether, this trade would have made about 20 points. There are many firms that do tremendous amount of statistical arbitrage trading for technical reasons, and that includes shorting. Fundamentally, business might be bad. The price of the stock might be inflated relative to what's going on in the underlying stock. Here you see a company that's not doing well, their revenue dropping from 9 billion to 8 billion. Oh, that's GameStop. This is what happened to GameStop's revenue, which is why a lot of people wanted to sell it short. Is selling short a good thing? Does it have a purpose? Well, to answer that, let's take a look at a typical stock and let's see if shorting is important. Let's take a look at Apple. The average volume over the last year, average daily volume, is 112 million shares. Now, I just said most stock does not trade. 112 million looks like a lot of trading, but it's not when you consider there are 16.8 billion shares outstanding. On any given day, 0.6% of Apple trades. Let's take a look at a recent quote for Apple. The bid, which is what someone's willing to pay, was only for 1,100 shares. The ask, which is the offering, also for 1,100 shares. That is minuscule compared to all the Apple stock out there. One of the problems with stock trading is that anyone can buy a stock if you've got money. The only person who can sell is an owner of the stock or a short seller, which could include the designated market maker, which are financial firms that work on exchanges that are tasked with making sure there's an active market in every single security they're responsible for. So when you think about Economics 101, which I teach, when there's a limited supply of a good or a service, what does that imply? Well, ceteris paribus, if there's a limited supply, all other things being equal, it puts upward pressure on price. So there are times when there's very little stock available, all other things being equal, the stock might be higher than where it should be. It's gotten ahead of itself. So short sellers step in and they offer stock cheaper than the people who own it. So new people who want to buy it are buying it cheaper than from people who already own it. Short sellers keep markets liquid. They play an important part in the marketplace. All right, so now to understand a short sale, let's follow a short sale transaction. Let's assume I think Johnson & Johnson stock is too high at $100. I want to borrow 100 shares and I want to sell it at 100 to a buyer. 100 times 100 is $10,000. So here are the players. I'm the short seller. There's a buyer who's interested in purchasing 100 shares. I have an account at XYZ brokerage firm, and there's another customer, we'll call them the XYZ customer Johnson & Johnson owner. They have 100 shares of Johnson & Johnson in their account. I want to borrow those shares and sell them to the buyer. So I go to XYZ and say, can you lend me some shares? They take the 100 shares from the customer who owns them. They make a book entry that says this stock has been loaned out. As far as the Johnson & Johnson owner, they still own the 100 shares. Those 100 shares are lent to me, and I give back to my brokerage firm an IOU. I have to replace those 100 shares. I then take the 100 shares and I sell them to the buyer. The buyer pays me $10,000, 100 times 100. I then take that $10,000, and unfortunately, it's not mine free and clear. I have to post it as collateral. That $10,000 is restricted until I replace the shares, so I'm going to put it in prison. For the purposes of this discussion, that's good enough. It's more complicated than that, but that gets to 90% of the gist of what's going on here. After the borrow and sale, here's where we stand. The buyer's happy. They bought their 100 shares. They go away. I have $10,000 that's in prison. I can't get it until I replace the shares. As far as XYZ customer J&J owner is concerned, if they look in their account statement, they will see they have a long position for 100 shares of Johnson & Johnson. They still own it. There's a book entry that says it's been lent out. In fact, very large customers who own lots of stock get paid fees for lending their stock. Okay, now let's say I was correct and the price went down and I want to unwind the transaction at 90. A new seller has entered the marketplace. I buy the 100 shares from the new seller. I give them $9,000 of my money. They give me the 100 shares. I then take the 100 shares. By the way, the new seller has his $9,000. They're happy. They go away. I take the 100 shares. I give them back to XYZ. They rip up the IOU. We erase the book entry. My $10,000 is now out of prison. It's my money. I now have the $10,000 free and clear because I met my obligation. I returned the borrowed shares. I sold shares for $10,000, bought them back for $9,000, made a $1,000 profit. That's how a successful short sale works. Wait a minute. What happens if I'm short and the price goes up? For example, in GameStop, or as we'll see in Northern Pacific Railroad. So after the borrow and sale, here's where we stood. I owed 100 shares back to XYZ brokerage. They had 10,000 of my money. But let's say the price doesn't go down, it goes up to 150. So now 100 shares is going to cost 15,000. 10,000 is not enough collateral. I'm going to need to come up with another 5,000 in collateral because XYZ brokerage wants to know they always have enough money on hand to cover the short. So when you're short and a stock goes up in price, you have to come up with more money. Okay, let's take a look at two financial manias to see if they look anything like GameStop, and surprisingly, they do. Back in 1841, Charles Mackay wrote a fabulous book called Extraordinary Popular Delusions and the Madness of Crowds. He talked about crowd behavior. He talked about many different examples. He talked about alchemists, where for centuries people thought there were people who could turn lead into gold. Hundreds of witches were killed over hundreds of years in Europe and in the United States. And he talked about financial manias. Now, if you look at the cover of the book, we see stock prices because the financial manias are things that are very relatable to people today. One of the financial manias he talked about was tulip bulbs. Here you see a blank chart. I'm going to fill it in. We're going to examine what happened to the trading in tulip bulbs back in 1634 to 1637 in the Dutch Republic. We see the prices on the left-hand side go from about 1 guilder to 60 guilders. Tulip bulbs were very, very actively traded. They started going up in price as speculators started buying. The word got around, buy tulip bulbs and you make money. Prices kept rising. By 1636, believe it or not, there was a futures market. You could actually sell tulip bulbs short for future delivery a few months down the road. Prices started going up even faster. And now the thing that destroyed the market, there were several things, but most important, people started using leverage, which is borrowed money. People actually mortgaged their homes to buy tulip bulbs because look at the graph, they only go up in price. Prices skyrocketed, and by 1637 were 20 times where they were 2 years earlier. From Investopedia, some rare bulbs traded as high as 6 times an average person's annual salary. It's not easy to believe that, but it's true. Prices skyrocketed. And then all of a sudden, when they got up to 60, and there were individual bulbs that traded for much more than this, buyers backed away. They said, wait a minute, is this stuff really worth this? But the loans needed to be repaid, and all these investors had were these overpriced tulip bulbs. And here's what happened in the next year. The market collapsed. Coincidentally, from 1635 to 1636, bubonic plague killed 10% of Amsterdam. Let's think about that for a minute. Crazy financial doings during a time of pandemic. Perhaps there's some correlation here. Second financial mania I want to talk about is the trading in Northern Pacific Railroad. I first learned about the trading in Northern Pacific Railroad a long time ago when I read a phenomenal book called The Reminiscences of a Stock Operator. If I accomplish nothing else on today's call, if one person goes to the library and reads this book, I believe my copy is still out on loan to one of my nephews. An all-time Wall Street classic, the blurb on the cover, the most entertaining book written on investing. It's fiction, but it's inspired by the life of a real stock trader, Jesse Livermore. And in the book, the author, Edwin Lefebvre, goes into detail about what happened in the stock trading in Northern Pacific Railroad back in 1901. The trading was so infamous, it's known forever as the Northern Pacific Corner, as two men tried to corner the stock. In April 1901, the stock was trading up from 90 to 100. There were two men, E.H. Harriman and James Hill, that wanted to control the stock. These were railroad barons. They had big positions in other railroads, and they wanted to control Northern Pacific because it fit with their portfolio. Harriman was backed by Wall Street banker Jacob Schiff. Hill was backed by J.P. Morgan, another Wall Street banker, the very famous Wall Street banker. By the end of April, the two men together owned 630,000 of the 800,000 shares. They each owned over 40%. On Friday, May 3rd, the stock went out at 110. Hill sends a wire to Morgan. Send me $15 million and I can buy the stock I need to gain control. Morgan agrees. On Monday, May 6th and Tuesday, May 7th, Hill buys 124,000 shares. At this point, there are only 46,000 shares remaining that aren't owned by Harriman or Hill. These 46,000 shares are known as the float. What's the float? The float is the number of shares that are available to trade. Because insiders and other restricted shares don't really trade their stock, and they don't make it available for loan to short sellers. But over the 2 days, May 6th and May 7th, it's estimated that over 250,000 shares or more were sold short as the stock price ran up. What was going to happen? What follows here are screen clippings from the New York Times. By the way, every page of the New York Times since it was first printed is available online. Here we see the trading in Northern Pacific. We start on Monday, May 6th. Hill begins buying 124,000 shares. The stock trades up to 127.5, up 17.5. On the 7th, he continues buying, and the stock goes up another 16 points. I don't have the intraday data. By now, the shorts realize there isn't any stock available for them to borrow. They were selling it before they borrowed it. Today, you have to secure the short before you have to borrow the stock before you can short it. The short squeeze is on. On Wednesday, May 8th, the trading is frantic. The stock trades as high as 180 before backing off to 160, up 16.5. That night, all over the city, especially on Wall Street, the only thing people were talking about was Northern Pacific. The trading was so frenzied that the next morning on page 1 of the New York Times, they printed, "Brokers acted like insane men." And all the while, there was much yelling and shouting, as had not been heard even on the recent wildest days in the street. But the trading on Wednesday, May 8th was tame compared to what followed. On Thursday, May 9th, all hell broke loose. The stock opens at 170. That was the low of the day. The high was 700. There was pure blown panic. There are reports that stock traded off the floor at 1,000 as the shorts were desperate to cover. Stock trades at 325 at the close, up 165. More importantly, the whole market traded down. General Electric was down 10. United States Steel was down 6 3/4. Both of these were down 20 points during the day. Two things happened. The shorts sold whatever they owned to raise cash to put up more collateral. And other people saw the prices going down. They started to panic and they started to sell. The next day, there was a court-ordered settlement. Both sides, Harriman and Hill, reached a truce. They agreed to allow the shorts to cover their positions at 150. All the trading took place at 150, except one high sale of 160. Stock was down 175 points. We all recall how the news was just wall-to-wall GameStop. Let's see how this was reported in the New York Times on May 10th. By the way, it was 16 pages and it cost a penny. The front page had 7 columns, 6 of them devoted to Northern Pacific. Disaster and ruin in a falling market, panic without parallel, losses of untold millions. Northern Pacific corner exposed. Court order leads to a final break. The paper got it exactly correct. The enormous purchases made recently by the Harriman Syndicate and the Hill Morgan Syndicate had completely cleared the market of all floating stock, so that the shorts were placed in the position of having to deliver stock that they did not own and which they could neither buy nor borrow. And there was tragedy. Samuel Bolton Jr., the Troy brewer, believed to have killed himself. by diving into a vat of boiling beer, said to have lost millions in the stock market. Okay, which brings us to GameStop. And as we're going to see, what happened to GameStop looks an awful lot like tulip bulbs or Northern Pacific. We've all seen GameStop stores. They have approximately 5,000 stores in 14 countries. They sell new and used video games. They've closed about 500 stores in 2020. They also sell games online. Let's see how they're doing with some data from Yahoo Finance. We're going to look at revenue and net income. You've got total revenue of 9 billion, 8, 6, 5. Net income. The last time they made money was back in 2018. They lost 673 million in 2019, 470 million in 2020. By the way, earnings just came out yesterday. These are approximate numbers because I haven't had a chance to adjust them all. They lost 153 million. In the last 3 years, they've lost over 1.2 billion. Revenue is down over 40% in the last 4 years. This company is not doing well. And as a result, hedge funds shorted GameStop in size. The largest short seller was a hedge fund called Melvin Capital. Cintron Research, 0.72, and many others said this company is doing poorly. We should sell them short because the price is going down. So let's see how big the short position was. The estimated float, the stock available for sale, 54.5 million shares. Again, remember, what's the float? It's the number of shares available to trade. It excludes insiders and restricted shares. For the end of the year, for both the end of November and December, there were 68 million shares short. Hold on. There's only 54 million shares available, but there's 68 million short. We'll come back to that. The price was trading up from 16 to 18 and change. The dollars short were 1.1 billion up to 1.3 billion. The percent of float short, you take the 68 million that people are short, which, by the way, when a stock is sold short, a note is made, and there are services that tally up the number of shares that are sold short. The identity of the short seller is not disclosed publicly, but the amount of short stock is. You take the 68, you divide it by the 54, the stock was 125% short, and there are points in January where that number might have hit 140. How out of line is that? Let's take a look at some typical percent of float shorts. 3M is about the most typical American company you can find. They make Scotch tape, duct tape, Post-it notes, and N95 masks. Last month, the typical short divided by the float was 1.6% of the shares outstanding, of the float shares outstanding. Microsoft, we all know what they make. The short position is approximately 0.6% of float. So 125% is outrageous. How is that possible? Did they not hear about Northern Pacific? How is it even physically possible to short more than the float? Let's go back and take a look. Where were we after the borrow and sale? I owed 100 shares to XYZ brokerage. They had my 10 grand in prison. The XYZ customer, they still own the 100 shares of Johnson & Johnson, but I sold them to another buyer. As far as the buyer is concerned, they own 100 shares of Johnson & Johnson. They very much can go lend that stock out to another short seller. But on the other side, there were true believers. Here we see a picture of Keith Gill, also known as Roaring Kitty on YouTube. He bought 50,000 shares in 2019 at approximately $5. Take a look at his t-shirt. There's the Roaring Kitty. He was a true believer, and he bought stock extremely cheap and said at $5, it's worth a shot. A much larger buyer was Ryan Cohen, the CEO of Chewy, the pet food supplier. He sold Chewy for $3.4 billion in 2017. He has purchased, by August of 20, had purchased 10% of GameStop between $5 and $10. So there were people who were big fans of this stock at low prices. Which brings us to Reddit, the internet message board. There are thousands of subreddit communities. There's one dedicated to pictures of people's pets. There's a Reddit called Ask Reddit, where you can go on there and ask any question about any topic, and maybe you get an answer. And then there's Wall Street Bets, a subreddit. Wall Street Bets is now either number 1 or number 2 in terms of activity on Reddit. Wall Street Bets has been described as a cult, a place where cult members meet cult stocks, which then begs the question, what is the definition of the word cult? It's a noun, a system of religious veneration and devotion directed toward a particular figure or object, and it kind of fits with the devotion to GameStop stock. So what do you see on this information billboard? You see postings that look something like this. If GameStop hits 800 before 226, we will trigger the mother of all short squeezes. This one post received 6,100 comments. Another word that you see a lot on Wall Street Bets is stimmy. Stimmy day is here. There's always money in the GME stand. Stimmy is short for stimulus check. There are hundreds, if not thousands, of posts encouraging people to use their stimulus check to buy GameStop. And there are numerous posts showing open antagonism towards Wall Street. An open letter to Melvin Capital. You stand for everything that I hate. So we have thousands of people passing messages back and forth all day, many of them promoting people to take money and buy GameStop. Some other PG-rated terminology I can share. There are dozens, hundreds, if not thousands of posts that reference diamond hands. Buy GameStop and hold on as if it were a diamond, or hold it with a grip as tough as a diamond. Basically, buy and hold. There's also a lot of posts that reference the word YOLO. You only live once. Again, going back to Holland back in 1635, perhaps there's a fatalistic attitude towards investing during a time of pandemic. How big is Wall Street Bets? We started the year with 1 million users. There were only 329 posts that generated 15,000 comments. GameStop was 1884. 3 weeks later, they were up to 2.4 million users. There were over 1,000 posts with 65,000 comments. The stock had now risen to 65, and the commenting was at a fevered pitch. Again, what part did COVID play as we're stuck home receiving stimulus checks? This from the New York Times this past Monday. Recast as stimmies, federal relief checks drive a stock buying spree. The government set out to prop up the economy. Perhaps it's propping up the market. By the 27th, there were 3.4 million users. Post peaked at 68,000 with 394,000 comments when the stock topped off at 347. 2 days later, there were 3 million more users. Post had calmed down a little. Stock had backed off a little. 3 weeks later, they were up to 9.2 million users. How has the press described these people who are on Wall Street Bets? An army of traders, an angry mob, millions of amateur traders, an avalanche of average investors. Every army needs weaponry. This army needed trading technology, and into the void steps Robinhood. Robinhood Financial, also known as Robinhood Securities, providing easy apps to make trading easy. Their tagline is investing for everyone. They were the first to introduce commission-free investing, which then begs the question, how do they make money? And that is a subject for a different Zoom call. How much money do you need to invest with Robinhood? $1, and you can buy a fraction of a share. Okay, the GameStop table is now set. We have a massive short position. We have true believers. We have an army of traders who have time and money. They have the technology. We have Wall Street Bets information bulletin board, and they've got Robinhood to trade. Now let's examine what happened. Before this timeline, the timeline goes from September of 20. Keith Gill, also known as Roaring Kitty on YouTube, I cannot share his screen name on Wall Street Bets. He buys his 50,000 shares and he makes his first Wall Street Bets post 1 year before this timeline, September 2019. Ryan Cohen, also before the timeline, founder of Chewy, discloses he owns 10%, August of 20. Both of these men acquired their stock between $5 and $10. We start on September 1st at 765. The short position is approximately 50 million shares. On October 27th, a very important post on Wall Street Bets by Stonks, which is the slang for stock. Stonks Flying Up user makes the first post about the large GameStop short. The stock by Halloween has drifted up to 1047, which, by the way, a phenomenal increase from 765. Throughout this time period, Roaring Kitty and others are posting frequently about GameStop. By the end of the year, the stock is at 1884, a phenomenal move. The short position is now 68 million. On January 10th, Ryan Cohen joins the board of directors. The stock is now up 100% in 4 days. On January 13th, Jim Cramer of Mad Money on CNBC announces on his show there is a bull market in short busting, squeezing the shorts, making them buy their stock back. Over the next week and 2 weeks and change, by January 28th, Wall Street Bets now has its 4 million users. There are thousands of posts relentlessly telling people, buy GameStop and hold it like they're diamonds. The shorts are under tremendous pressure. They're out billions of dollars. Melvin Capital finally throws in the towel. On January 27th, they announce they are no longer short GameStop, and it closes at the all-time high of 348. Robinhood restricts trading in GameStop temporarily. They were having difficulty meeting all of their financial requirements to the company that handles all of its stock trading. Again, subject for another Zoom call. The stock rallies back briefly, but now with the short buying out of the marketplace, the market collapses to 45 by February 18. The short position has been cut from 68 million shares down to 16. Who's happy? Ryan Cohen, with GameStop at 160, his position is worth 1.4 billion, and in fact, he's purchased more during this timeline. Keith Gill, Roaring Kitty, has published snapshots of his account showing profits of 10, 20, or 40 million. One Reddit trader claims they turned 53,000 into 11 million with options. Thousands of Wall Street Better traders made money, 100, 1,000, 10,000, who knows? And there were clearly hedge funds and other wealthy investors who made money both by being long and by selling the stock short or buying other options on the way down. Who said? Melvin Capital said they lost 53% of their money in January. Maybe it was as much as 5 billion, certainly more than 3. From Forbes, Reddit traders have lost millions over GameStop, but many are refusing to quit. From the Journal, GameStop investors who bet big and lost big, lots of them are in the red. And there's been tragedy. Robinhood is currently facing a wrongful death suit over a young trader's suicide. His parents allege that he had an option trade that had 2 sides to it, was informed that he was out a lot of money on one trade, hundreds of thousands of dollars, but did not receive a message that he also had an offsetting profit on the other side. And that's, I'm sure, not the only story of tragedy to come from this. So what is GameStop really worth? When I started preparing this presentation, it was after it had cratered. I said, yeah, that's it. It's all done. But then the CFO resigned. Ryan Cohen got more involved. There were still many, many announcements on Wall Street bets encouraging people to buy, but there were also people on the other side now. And the short position has collapsed, taking away the other buying pressure. Recently, when it was 209, I did the following analysis. What other companies are worth 15 billion? What do they make? Campbell's trades around 15 billion in market cap. They're worth 1.6, they make 1.6 billion a year. Avery Dennison, the printing company, they make 500 million a year. Perkin-Elmer makes 700. GameStop, the last time they made money was 2018. They've lost $1 billion since. Can Ryan Cohen turn it into a successful venture online? Maybe. But I don't know. And there has been some negative press on Wall Street Bets, a recent post. The sub is now a cult. The fallout from this is going to be epic. Lost life savings, divorces, breakups, suicides. All for a meme. Get out while you can. One of the first responses to this: when has a cult ever ended badly? And so I'm going to leave you with the words of John Maynard Keynes. He wrote The General Theory of Employment, Interest, and Money, perhaps the most famous economist of all time. This book is the foundation for every macroeconomics 101 class taught in the world. We can't find this quote in print, but many people who know him said he said it. The markets can remain irrational longer than you can remain solvent. Okay, I hope you enjoyed the presentation. There's my email. Please, if you have any comments and any other questions, let's go. I'm going to stop sharing now and turn it back over to Orchidea.
Thank you so much, Todd. Thank you so much for a very interesting presentation. I really enjoyed it. I have some questions. I'm going to start by the first one. So are there other names like GameStop that have a large percentage of short float and perhaps subject to a squeeze?
Yes, probably the second most famous is AMC, the theater chain. AMC hasn't had people in the theaters in over a year. It has seen similar upward pressure and then backed off a little bit. Yes, there are other names that traders on Wall Street Bets have focused on. I spent most of my time focused specifically on GameStop over the last couple of weeks. But yes, there are others with large short positions which have that extra underlying buying strength.
Thank you so much. So we have 2 questions about the options. One of them is that you did not discuss options trading. Could you describe what happened in GameStop options? And another question is, what is your opinion on options? Can you use shorting strategies on put options?
Sure. Okay. The reason why I didn't go into options, we have an hour to handle this topic, and it's a huge topic. Options, for those who are not familiar, are contracts where you have the right to buy and sell a stock at a fixed price. So in other words, when GameStop was trading at 150 on the way up, you could buy the right to buy it at 180, maybe for $5 or $10. And then it would keep, if it keeps going up, beyond your strike price, then you might make money. One of the things that happened in GameStop, because of the hectic trading, the amount of premium, the extra money you had to pay for options was astronomical. There were options that were a typical stock option might imply a stock could move 25% in a year. There were stock options for GameStop that traded implying that the stock would move 400% or 500% a year. So the amount of premium, the extra money you had to pay for an options contract was outrageous. There were lots of big Wall Street traders who sold options, sold call options, because of the inflated premium. When the stock was at 250, they were selling options to sell the stock at 400 and 500. And then when they expired and the stock hadn't reached that, all the money they took in from selling those calls, they made money on. Now, were there people who bought put options? Melvin Capital at one point disclosed that they owned put options on 6 million shares, which means that they lost all their money on the way up because these things expired worthless. Having said that, there are many people who have traded the option successfully. My gut feel tells me most of that on the short side because the premiums were so inflated that deep out of the money calls certainly expired worthless. Were there traders who made money trading options? Yes, of course there were.
Thank you so much, Todd. So what is your recommendation for somebody who has some positions in EV stock, especially Tesla, NIO, and CCIB? They're taking a lot of beating right now, and what should we do with them?
My goal here today was to explain the craziness in GameStop. Mm-hmm. Okay, I'm not a financial advisor, so I'm not going to even weigh in on these. Having said that, they're also, by the way, Elon Musk, a big supporter of the crowd, and at one point actually tweeted something about GameStop, but he called it GameStonk. Again, stonk being the abbreviation on Wall Street bets for stocks. But the answer is I don't have an opinion on EV stocks. I have an opinion on the underlying product. I mean, we're clearly moving towards more electric vehicles. Then the question is it worth it? I mean, GameStop could be a viable company. The only question is it worth 150?
Yeah, makes sense. But what would you do now in GME?
What in GME?
Yes.
If I had to, you'd have to sell it short still because they've lost over $1 billion in the last couple of years. Okay. Ryan Cohen thinks he can pull the same magic that he pulled with Chewy, which, by the way, if you look up Chewy, it now trades in the marketplace. He's never made a nickel. They've only lost money. Now, is there a chance eventually they're going to make money? Yes. Can he do something similar? Can GameStop move to an online retailer and be competitive with Amazon? That's possible. Right now, Chewy is definitely much considered to be a competitor with Amazon in the pet food and other pet supply market. Okay, can GameStop be the go-to place for people to buy their games online? Yes. Now the question is, can they make money doing it when they're competing with Amazon? Don't know.
Mm-hmm. Thank you so much. So the message board Wall Street Bets sounds like a quote-unquote boiler room. What exactly is a boiler room, and how is Wall Street Bets different? And do you think the activity there is illegal?
I've read a few articles on this point. What is a boiler room? If you saw the Wolf of Wall Street movie, you saw a boiler room. A boiler room is a marginally legal, probably mostly illegal, a stock selling room where there are stock salesmen who are basically lying about the underlying stocks, putting lots of pressure on customers to buy, even though these things are probably worthless. And there's a lot of high pressure tactics being used on people. Now in Wall Street Bets, and I read a lot of the posts, most of them were simply saying, buy GameStop, you can't go wrong. Maybe that's too much of stretching it, but most of it was just saying buy and hold. What is diamond hands? Diamond hand means buy and hold. There's nothing illegal with buying a stock and then advertising it and saying, I love this stock, I'm holding it. Nothing illegal with that. Illegal to say, buy it and it's going to go to 1,000. I know you can't say something like that. And you can't. The short answer is, I don't think it's a boiler room. it has some aspect to it because of the constant swirl of information where people are all saying the same thing, buy GameStop, buy GameStop. Having said that, the pressure tactics, no, I didn't see the pressure tactics there. I didn't see people lying about it. They're basically saying there's a huge short position. The stock's going to go up in price, which was factual. Again, there are so many posts. To be sure, there will be lawyers going over these posts to take a look to see if there were things on there. But again, this is a much bigger topic because our social media sites, and essentially Wall Street Bets is a social media site, are they responsible for the content on the site? And again, not an expert in the topic, but is Facebook responsible for the content that's on their site? Very similar.
Thank you so much. We have a personal question from you, Todd. What type of trader were you? Did you do options, day trade, or swinging? I don't think you mind answering that question.
No, well, the example that I gave on MasterCard and Visa, that was the bulk of my trading. I started back in 1985 when the phone company split up into 7 individual baby bells. You've never seen 7 companies more alike. Therefore, they should have traded very, very similar. So when then 1 or 2 of them got out of line with the others, there were tremendous trading opportunities. And that we're talking about for $1 or $2. But the statistics were there that said, this stock has gotten out of line, 80% shot, it's going to go back into line. In which case, so almost all the trading I did was pairs trading, where I would sell something if I thought it was overpriced, buy something I thought it was underpriced, and unwind it if they came back together.
Thank you. One of the questions says, would you not agree that the due diligence of some of these people was pretty good to find and continue to find great short squeeze opportunities?
Oh, there's no question, okay? Do I think at 150 or 200, it's a good short sale? Probably. But the true believers who bought it at 5 and 10, okay, Roaring Kitty and Ryan Cohen, okay, they were buying something and it's like having wind at your back, okay? If there's a large short position, that's like having wind at your back. You have underlying buying strength behind you, okay? The thing that confused me the most was after the big drop down of 45, it went back to 250. But the big wind at your back, which was short buying, was gone. All the huge shorts had left. Keep in mind, still short 10 or 15 million shares. It's a big short, but it wasn't the outrageous short as before. So yeah, was there some good due diligence pointing out that there was a short that was outrageous? Absolutely.
Thank you so much, Todd. I think you already answered this question. What is your opinion on the possibility of a short squeeze still happening? In the recent GameStop filings, they mentioned they are willing to sell shares in order to capitalize on a squeeze. So,
well, when you have a stock that's trading at 5 and 10, and then it goes to 250 or 200, if you're the treasurer of that company, the CFO, you have to be thinking about selling stock. Because, oh my God, your stock was 10, now it's trading at 250. Sell some stock.
Exactly. Thank you so much. So following the recent market correction, is there any possibility that the correction is going to happen again?
In terms of the correction in
market
GameStop.
Correction? Yes.
Market correction.
Yeah.
Has there been a market correction? The market's trading within a breath of the all-time high. Okay. I mean, the market has done extremely well this year. Has there been a backup in information technology stocks? Sure, but after a humongous run last year, so perhaps expected.
Thank you so much, Todd. Let me see if we have any question that I missed. So I believe this question is not about, short selling. Do you know the average return on investment in the stock market? What is more important, technical or fundamental analysis?
Difficult to answer the question because, when I was in business school, it was simple. Stock market makes 10% a year. Okay. That was the rule of thumb. Over long periods of time, guys, there are 10-year stretches where the stock market's done nothing. where the Dow Jones Industrials literally is in the same place 10 years later. There are some stock markets that still have never recovered from their all-time high. If you look at the Nikkei, which is the Japanese stock index, it still has not recovered to where it was in 1990, okay, because it was outrageously overpriced. Since the market went down dramatically in 2008 and 2009 during the recession, and basically it's been going up ever since. Have there been big reversals during there? Sure, there have been a couple, but it's still very strong. And over the last 3 or 4 years, throughout the Obama administration, the stock market was very strong. I mean, it bottomed out right after the 2008, 2009 recession, took off, and it kept going up, continued going up under Trump. So the answer is the stock market's done extremely well. There's one unusual item going on here. Up until 5 years ago, up until 2008, so up until 2008, 2009, we had a real interest rate. Okay, the 10-year would trade at 3%, 4%, 5%. As soon as we had the recession of 2008, 2009, the Federal Reserve lowered interest rates to the point where the real rate is effectively zero. So investors who have cash and can't invest it in fixed income because you can't earn any money, perhaps there's been more of a shift towards equities because there's such low returns in terms of the interest rates being paid on fixed income securities. So that has definitely been a bias towards stocks, and it continues today. In response to pandemic, the Federal Reserve has taken the Fed funds rate close to zero. Okay, you can't get any money in a money market fund right now. You can't earn any interest. So it's definitely influenced people to move towards stocks, and especially more conservative people to move towards dividend stocks.
Thank you. Yeah, makes sense. Maybe the last question is, would you say that GameStop currently is on track to becoming a company like Kodak in the stock market if they do not innovate or to compete with companies like Amazon?
Well, that's the whole point. I mean, Ryan Cohen, between $5 and $10, said, you know what, let me take a large position. Maybe I can do with GameStop what I did with Chewy. He took on Amazon selling pet food and other pet novelties. And so far, he's been fairly successful. Can he do the same thing with GameStop? I don't know. I don't know enough about gaming. For Chewy, lots of their customers are on subscription because you need to keep getting food for your pets. I don't know that GameStop's going to have like a subscription because I assume most people like a specific game when it comes out. The answer is I don't know enough about the product. I'm skeptical if they can. That he can do the same magic again. It's possible. Anything's possible. I will then leave everybody again with the words of with Keynes. Hang on, John Maynard Keynes. I want to get the quote correct. The markets can remain irrational longer than you can remain solvent. And once again, we've certainly seen that the market has been somewhat irrational. For a stock to trade 10, 300, 250, 300, 45, 250, and now back down to, where is it today? The last trade taking place at 145, down 36 on the day. So yeah, I would say the trading's a little hectic, perhaps irrational.
Well, thank you so much. Makes sense. I really personally enjoyed it. Thank you for sharing your knowledge and expertise with us, Todd. I think we're gonna make this video available to the participants because some of the questions we're asking about, the recording. And I once again thank you so much, and I thank all the participants for their time. Okay.
Orchidea and Morgan and Venetia, thank you very much for all your help. I had a lot of fun putting this together. If you have any questions, again, my email, fettermant@montclair.edu. Take care, everybody.
Thank you all. Bye.
Bye-bye.
Bye, everyone.